Let me tell you something that most people are completely ignoring right now, and that ignorance is going to cost them. While everyone is obsessing over AI stocks, crypto rebounds, and whatever consumer tech darling is trending this week, there's a sector sitting right in front of us, backed by the most reliable customer on the planet, poised to deliver serious returns in 2026. That sector is defense. And no, I'm not talking about some abstract geopolitical theory. I'm talking about money. Cold, hard, contractual money. The kind that gets appropriated by governments, locked in for years and paid out regardless of whether the economy sneezes or catches a full-blown fever. I've been in the investment world long enough to recognize when a setup is being ignored. And right now, defense stocks have a setup that serious investors cannot afford to sleep on. So here's my question for you, and I want you to answer this in the comments right now. Are you currently holding any defense stocks in your portfolio? And if not, why not? Because your answer is going to tell me everything about how you think about money. Drop it below. I read these. Now let's get into it. The world changed. I know everyone says that, but this time the numbers prove it. Global defense spending hit over $2 trillion in 2024. $2 trillion. That's not a blip. That's not a reaction to one conflict. That's a structural, sustained, multi-year shift in how governments are allocating capital. NATO members are being pushed hard, some being pushed publicly, some privately, to hit 2% of GDP in defense spending. Several haven't gotten there yet. That means the money is still coming. The contracts haven't all been signed. The procurement cycles haven't fully kicked in. We are early in this. When I see a customer with essentially unlimited credit, long-term buying commitments, and a growing list of things they need to purchase urgently, I don't overthink it. I ask one question: who's selling to that customer? Those are the companies I want to own. Think about the businesses that operate in defense: Lockheed Martin, Northrop Grumman, RTX, formerly Raytheon, L3Harris. These are not startups burning cash on hope. These are complex, established businesses with decades-long government relationships, classified programs, and backlogs that stretch years into the future. A backlog, for those who need a refresher, is effectively pre-built revenue. Northrop Grumman has been sitting on a backlog exceeding $80 billion. That's money they're going to collect. The business is already written, they just have to execute. Now contrast that with most of the hot names people are chasing right now. You've got companies trading at 70, 80, sometimes over 100 times earnings based on projections, potential, and prayer. There's no backlog. There's no government contract. There's no guaranteed revenue stream. There's a story. And stories are wonderful until the narrative breaks, and then you're holding a stock down 50%, wondering what happened to your conviction. I don't invest in stories, I invest in structures. Defense is a structure. Let me walk you through the psychology of why most retail investors underweight defense and why that's a mistake that consistently costs them. People tend to invest in what they understand emotionally. They buy what they use. They buy what excites them. Defense is not exciting in the consumer sense. Nobody's lining up to see a next-generation missile defense system the way they line up for a phone launch. There's no hype cycle. There's no social media frenzy. There's no Reddit thread pushing it to the moon. And that is precisely why the opportunity exists. The best investments are the ones that feel boring to the crowd, but are mathematically compelling to anyone who actually reads the financials. That gap between public perception and fundamental value, that's where money gets made. I've built my career finding those gaps. Defense right now is one of the clearest examples I've seen in years. Here's another thing I want you to internalize. Defense companies operate with something most businesses would kill for: pricing power backed by necessity. Governments don't negotiate defense contracts the way you negotiate the price of a car. When a nation needs a specific advanced weapons system, a specific radar, a specific satellite capability, there is often only one or two suppliers in the entire world who can provide it. That's called a moat. That's called leverage. And that leverage shows up in margins. Let's talk about the geopolitical landscape for a moment, because this is the engine driving everything. We are living through a period of accelerating strategic competition between major powers. You've got tensions that aren't cooling down. They're institutionalizing. Defense budgets don't get built in response to a single event and then disappear. They get built in response to a perception of sustained threat. And that perception right now across the United States, across Europe, across the Indo-Pacific is firmly in place. When I look at European rearmament specifically, I see something remarkable. Countries that spent decades essentially outsourcing their security to the American umbrella are now writing checks of their own. Germany committed to a €100 billion special defense fund. That's not rhetoric. That's a budget line. Poland is spending 4% of GDP on defense, the highest in NATO. The UK is increasing. France is increasing. These aren't promises. These are appropriations, and when governments appropriate money, companies get paid. Now, the sophisticated investor also looks at risk. So let me give you the honest version of that conversation, because I'm not here to sell you a narrative. I'm here to give you a framework. The risks in defense are real. Political risk is the most obvious one. Defense budgets can get cut. We've seen it before. Sequestration in 2013 hit defense companies meaningfully. There's always the possibility that a new administration, a new Congress, a new political alignment decides to redirect spending. Program cancellations happen. Cost overruns can punish a stock even when the underlying business is healthy. The F-35 program, for all its strategic importance, has had its share of budget drama over the years. But here's how I weigh that risk against the opportunity. The current geopolitical environment makes dramatic, near-term defense cuts politically untenable in most Western nations. The public pressure is in the opposite direction. And even with normal budget volatility, the companies I'm looking at have diversified revenue across dozens of programs across multiple governments. A single program getting trimmed doesn't break them. Diversification within defense is just as important as diversification across sectors. The investor who understands that distinction is already ahead of most people in this conversation. I also want to address the ethical dimension because some people hesitate here, and I think that hesitation deserves a direct response. The argument goes, I don't want to invest in companies that make weapons. I respect that position. But let me offer a counterframe. National security infrastructure is, whether we like it or not, a fundamental function of sovereign states. The companies providing that infrastructure are providing a service that governments worldwide have decided is non-negotiable. You can debate foreign policy, you can debate specific conflicts, but the business of equipping a military to defend a nation is as old as civilization itself. Refusing to participate in that investment category doesn't change geopolitics. It just means someone else captures the financial return. I'm not telling you what to do with that. I'm just making sure you're making your decision with clear eyes and not just reflexive discomfort. Let me bring it back to the numbers, because that's ultimately what decides everything. Defense stocks have historically outperformed during periods of elevated geopolitical tension. Look at the performance of the iShares US Aerospace and Defense ETF, the ITA, over the past 2 years. Look at Lockheed Martin's revenue trajectory. Look at how Northrop Grumman is pricing its next-generation programs. The financial signals are consistent with a sector in an extended upcycle, not a temporary pop. And the dividend angle. Let's not gloss over this. Several major defense companies pay meaningful growing dividends. They buy back stock. They generate free cash flow that is largely insulated from the kind of consumer sentiment swings that hammer retail and tech. In a world where interest rates remain elevated and growth is uncertain, the combination of dividend yield, buybacks, and visibility of earnings is extremely attractive to institutional capital. And where institutional capital flows, prices follow. This is what I mean when I say most people are missing this. They're looking at defense stocks and seeing something dull. Institutions are looking at defense stocks and seeing a combination of yield, growth, and predictability that is genuinely rare in today's market. That mismatch is your entry point. But entry points don't stay open forever. The one tactical observation I'll leave you with, and I want to be precise about this because imprecision is how people lose money, is that valuation matters even in a strong sector thesis. Some defense names have already moved significantly. The easy money and some of the most well-known names may already be partially priced in. The more interesting opportunities are sometimes in the second-tier defense names, the suppliers, the technology integrators, the cybersecurity components of the defense ecosystem, the companies building the software layer for next-generation defense systems. Those businesses have exposure to the same spending wave, but with less institutional ownership, which means more potential upside as awareness grows. Do your due diligence. I can't do that for you, and I wouldn't if I could, because the discipline of doing your own research is what separates the investor from the speculator. Here's what I want you to walk away with. In 2026, capital is going to continue rotating towards sectors with real revenue visibility, durable competitive advantages, and geopolitical tailwinds. Defense checks all 3 boxes. The world is not becoming more peaceful on any timeline that matters to a 2026 investment thesis. Governments are not going to stop spending on security. The companies serving that need have business models built on long-term, contractual, government-backed revenue. That's not a prediction. That's arithmetic. The question you need to sit with is not whether defense is a good sector right now. The data makes that case without my help. The real question is whether you have the discipline and the conviction to invest in something that doesn't generate excitement, doesn't trend on social media, and won't make you feel clever at dinner parties. Because the best investments rarely do any of those things. Average investors chase what feels good. Serious investors follow where the money is structurally committed to go. I know which category I want to be in. The question is which one you're choosing. Drop your answer in the comments. Tell me, are you in defense? Have you been watching this space? Or did this just change how you're thinking about your 2026 portfolio? I want to know where your head is. Let's have that